Thank you for joining us at XM.com for this preview video. With the Fed in its blackout period ahead of next week's gathering, investors will have to completely rely on data releases to assess whether the Fed will hike rates again next week. I'm Cristina Marujos. With me today is Senior Investment Analyst Marios Hadjikyriacos. Marios, this week holds crucial data releases from the United States, with the spotlight falling on preliminary GDP figures on Thursday, followed by the Fed's preferred inflation metric, the core PCE Price Index, on Friday. What are we likely to see in the data?
Hello, Christina. Well, the economic data out of the United States has improved quite significantly in recent months. So, business surveys point to an economy that is reaccelerating. Growth momentum has returned. The banking crisis has receded for now. The unemployment rate remains near historic lows. So when you combine everything together, it really seems that the fears of a recession that we saw earlier in the year, well, those fears were a little bit overblown, or at least premature. Now, of course, the economy might be reaccelerating, but there's also a dark side to that. And the dark side is that inflation has also received a second wind. Companies are taking advantage of this increase in demand, and they are raising their selling prices at a pretty fast clip. That has been reflected in core inflation, which hasn't really cooled. So it seems that the Fed's job is not done yet. And yet, investors think that the Fed is about to conclude its tightening cycle. Market pricing suggests that we are going to get one final rate increase next week, and that's it. The Fed then moves to the sidelines for a few months until it begins cutting interest rates towards the end of the year. So the data that we're going to get this week, most importantly the GDP number, it's going to be really important in shaping this narrative. Is the Fed going to start cutting rates soon, and how long might it take before we get there? Now, the forecasts suggest that the US economy grew at an annualized pace of 2% in the first quarter. Now, if there are any surprises, I see some scope for a stronger than expected number, considering that the Fed's GDP Now model estimates economic growth, GDP growth, at 2.5% instead. And this is a fairly accurate model. It tends to get the surprises right. So there's some scope for an upside surprise in GDP. And on Friday, the following day, we're going to get the core PCE Price Index. It's always important for the Fed. It's also going to be crucial in shaping the outlook about interest rates and, of course, about the dollar.
And speaking of the dollar, should the data support another Fed rate hike next week? What should dollar traders anticipate?
Well, as we just mentioned, the dollar might get a small boost from upside surprises in US data. But the theme, really, Christina, in recent months has been that, yes, we've seen a lot of strong data from the US, but the dollar has been unable to capitalize in a sense. The dollar has been underperforming. And in my eyes, at least, some of this weakness is connected to the brightening outlook in Europe. We've seen the market pricing in continued rate increases by the European Central Bank. That has helped boost the euro. But perhaps and of course, when the euro rises, that's negative for the dollar. But an even bigger driver for this dollar underperformance, I think, has been the cheerful mood in stock markets. So the correlation between euro dollar and the S&P 500, or cable and the S&P 500, the 30-day rolling correlation between this currency pairs and the stock market is around 86%. That's a really, really high. So that really shows you that it's all one interconnected trade right now, and that is the stock market is in charge of the ship, in a sense. It's really a risk sentiment that is in the driver's seat, and the Forex market is really moving based off of that. So from that perspective, well, you could say, well, if the stock market turns, chances are euro dollar and cable are also going to turn. So what are the chances that the stock market turns? Well, in that sense, I'm quite pessimistic on the stock market in the following sense. Valuations are really expensive, quite expensive even for compared to recent years. And we're now in an environment where earnings are actually declining. We're looking at an earnings recession in the stock market. So there seems to be a disconnect between rising stock markets and a deteriorating fundamental landscape combined with valuations being quite expensive. So, long story short, I see more risk than I see reward in the stock market. I think that the risks surrounding the stock market are tilted to the downside, and therefore I also see scope for a revival in the dollar over the coming months.
Marios, thanks so much. Great having you with me today. And thank you for watching this video here at xm.com.